Okay, so what you see now in front of you is a diagram, and this should explain the concept of outstanding checks. Okay, so here we have a payor. So let's call this payor Mr. A, and Mr. A wants to pay payee, or Mr. Blue, a certain amount of money. So what will happen is Mr. A will write a check to with Mr. B as the payee, and from the in the book of the payor or Mr. A, what will happen is there's already a decrease of cash. Now, the thing is, there's a time lag. Let's say Mr. B says, I will go to the bank next week to deposit this check. So let's say today, Mr. A has already recorded in his notebook at home that his cash decreased by, let's say, 2,000 pesos. But because Mr. Blue decides to just deposit this check next week, so as of today, the bank has no clue that the deposit account of Mr. A should be reduced by 2,000. So at this point, there is an incongruence between the record of Mr. A of his cash balance versus the record of the bank of Mr. A's cash balance in his deposit account. So in summary, what happens is if the payee doesn't go to the bank right away on the day that the check is given to him, then there will be a time lag, and the record of the payor and the record of the bank regarding the payor's deposit account will not be the same. So Mr. A will already have the decrease of 2,000 in his record, while the bank has none of that transaction yet. So this is what an outstanding check is called. The check is already out, but the bank doesn't know that Mr. A has given this to Mr. Blue already. Okay, now, so we move on to the topic of check clearing. So let's say, what happens is Mr. Blue, our payee from the previous slide, deposits in BPI, which is where his savings account is registered. And let's say Mr. A's check is from Bank A, wherein Mr. A's deposit account is registered. So in this scenario, Mr. Blue goes to BPI, his branch of account, deposits the check from Mr. A. And what happens here, since the check of Mr. A is not registered or is not issued by BPI, what BPI will do is send that to PCHC, or the Philippine Clearinghouse, and the Philippine Clearinghouse will bring that to Bank A. Now, the check was issued by Bank A, so Bank A will have the record of Mr. A. And what Bank A will do is check Mr. A's savings account, see if he has enough money to fund the check or to pay the amount that he wrote in the check. And if he does, then Bank A will honor the check and BPI will be notified. And once that BPI is notified, then Mr. Blue can already convert the check to cash, or Mr. Blue will see in his deposit account that the amount of the check is already withdrawable. And so that's a scenario when the check is actually honored. But if, for example, it goes through the clearinghouse and Bank A, upon checking Mr. A's account, sees that Mr. A doesn't have enough money, what Bank A will do is give this back to the clearinghouse and the check will be back to BPI, and BPI will call Mr. Blue and say, you know, the check that you deposited bounced, so you have to get it here and tell Mr. A or the payer that he has to issue you a check that is sufficiently funded. Now, the clearing process takes about 2 to 3 days. And while that's happening, then as the payee, you can't withdraw that amount yet from your savings account until it is cleared. Now, for deposit in transit, this means that these are the unrecorded deposits by the bank. So one example would be the check that is still being cleared, as I showed you earlier, and cash deposited after banking hours. So you might be thinking, how could this happen to actually deposit cash after banking hours if the branch is closed? Well, that can happen if, let's say, you go to machines wherein they accept cash. So what happens is some of them don't record real time, and it would take like a few hours until they take note of the deposit. So that could be, let's say, if you deposited at 9 p.m., then maybe they'll check it at they'll see it at 8 a.m. in the morning. So that's an example. Now, additional terms from the bank reconciliation. The debit memo and the credit memo here should not be confused with the debit memo and credit memo in the merchandising business. Here, we are using this in the context of bank reconciliation. So, when you say debit memo, this is a general term for any reduction of cash in the record of the bank. One example of that is bank service charges. So what happens here is when you look at your bank statement, let's say you have 3,000 pesos in your deposit account, but you realize that there's actually 1,000 pesos bank service charge that was given to you, or that was deducted from your cash amounting to 3,000. So let's say the bank service charge was 100, so you'll see your cash 3,000 minus the bank service charge of 100. It means that in your deposit account you only have 2,900. So that's in the record of the bank. Now, if you say credit memo, this would be any addition to the cash in bank. So, for example, in the bank statement, you see interest earned from deposits. So nowadays, interest is about like 0.5%. You barely feel it, but there was a time wherein you can actually get 10% increase from your deposit. So for example, if you have 100 pesos in your savings account, you can get 10 pesos additional and you'll have a total of 110 pesos. Okay, so let's go to the main meat of this chapter, bank reconciliation. So on your left side, this would pertain to the record. This top part would be the record of the bank. And balance per books would be your own record of your cash. Now, in this gray portion, the add and less here, add and less, are the adjustments that you have to make considering the time delays in the recording of cash. And here at the end, your goal is to have equal values for the cash in the record of the bank and cash in your own record. So at the beginning, the cash balance per bank statement will not be equal to the balance per books. But after you make all the adjustments, then these two values should be equal to each other. Now take note that bank reconciliation is for your own record only, meaning even though you're adding and subtracting things here, doesn't mean that you call the bank and tell them, hey, there's a deposit in transit amounting to 500. You don't do that. They will eventually realize the time delays, and in the next month, you'll see that in your bank statement. But the purpose of bank reconciliation is just for you to check, where did my cash go? Am I really missing a certain amount of cash? That's why the bank statement and my own cash balance are not equal to each other, or is it only because of the time delays? So that's the main goal of bank reconciliation, to determine or to trace where your money is going, and to hopefully have an equal amount here, because otherwise either you made a mistake in the adjustments, or an employee might have stolen money from you. Okay, so on this side, you'll see your cash balance per books, okay? And then the reason why we are adding interest earned here would be, when you compare it with a bank statement, you realize that the bank already noted that you earned interest from deposit, but you wouldn't know this until you receive the bank statement, so you have to add that in your own record. Now, credit memos would be any additional cash that was recorded by the bank. So you have to add that to your own book, because you only know that after checking with the bank statement. Collections made by the bank would pertain to, let's say, someone owes you money and they deposit to your account. So for example, what happens here is you don't know that they deposited the money already. That will reflect in the bank statement, but you wouldn't know that until you receive the bank statement. So upon comparing, you have to add, because this value here would not be included yet in your initial balance. And then, of course, if there are errors, either add or subtract. Now, for debit memos, these are the decrease in cash in bank. So, for example, you were charged with the banking fees, and you will only find that out upon comparing with the bank statement. So, you subtract that from your cash balance in your own record. For the NSF checks, initially you thought that you were paid a certain amount already, so you have a balance here. So you deposited in the bank, but then apparently through the process of clearing, they notify you that the check that you deposited was an NSF check. So meaning your payer did not have enough money to pay you. So in this case, the assumption is you're the payee. So what happens is they notify you through the bank statement, and after notification, you have to subtract that amount from your own cash. For the return checks, same principle. Initially, you deposited in the bank. You thought it would go through, that you could encash it already in the future. But through the bank statement, they tell you, oh, this is a return check because of some errors, and you need to take this back and ask the payer to fix the errors. So what happens is you have to subtract that from your initial recording of cash. And then after the adjustments, you'll get a balance. Now, in the next video, I'll explain to you how this works, how the adjustments in the bank statement should work. Okay, so see you in the next video.